Hello again. So this FX presentation is going to be in response to a lot of market developments stemming especially from the UK. And as a Euro trader, I've kind of been camped out with the Euro USD, and so trying to get out of my camp and taking a look at what's really going on in global currency and FX. It took a copious amount of research, a lot of hours for the last since our last video. It's been numerous hours and tedious amount of research just to get a handle on what's going on in Europe. So the recent developments, these are kind of the major bullet points. So Great Britain claims they want to leave the EU officially based on the referendum. And then on June 30th, we have basically Mark Carney quoting that the fundamentals have deteriorated for British sterling. So by June 30th, everything was all bad for the British pound. And what's interesting also as a surprise kind of shock was that the EU gets downgraded to AA from AA plus by the Standard & Poor's on the same day. And the markets didn't seem to show much movement towards the downgrade of the EU. So that was kind of shrugged off, and in fact, the euro just kind of floated upward against the USD. So euro US dollar is just kind of seems to be going through kind of like a fit. And so July 5th, the most recent, I guess, development is going to be for today, essentially, is that the British banks declare they're going to lower capital requirements. So they're not going to increase capital requirements from British bank lenders. They're going to lower the capital requirements. So those are the recent developments. What eventually I'm going to talk about is the market reaction to that. So from the Europe's top trading partners basically are like, no, actually I want to talk about the UK Vantage point. So from the UK, as a perspective from the UK as London, City of London being the center of the financial universe, it's a little bit different than being on the west coast of America. So obviously, as a trader and as a retail trader, what have you, for the euro, it becomes ousted. You know, where it's sort of camping, like outside of what is really going on. So from the UK, I mean, basically the demand for global currency other than British sterling has gone up. So the demand curve has shifted. Central banks stand ready to increase supply and liquidity for the British pound sterling in the tune of like $250 billion, so $250 billion. The supply hasn't changed, so they haven't yet changed the supply. There's been an easing so far, and then there's been changing of hands in between the British pound and other currencies, but there really hasn't been a change in supply just yet. Another noteworthy point is that the City of London has been suffering or will suffer as a financial center and is currently going through a state of flux, with US banks basically taking a lot of their office workers in the City of London and either going to shuffle them over to maybe Paris or other places in Europe, other offices. And so JP Morgan is showing the most flux here, with thousands of workers being displaced. And what's also interesting is that some other London firms are also showing interest in temporary employee contracts. So they're willing to hire in temporary employees. And this is a big issue because the freedom of migration and the freedom of capital is two of the biggest underpinnings for the EU to allow UK to access their single greatest market, which is continental Europe. So these two freedoms need to be unrestricted to a certain degree, a favorable degree for both EU, Europe, and UK. And the number one priority for this deal to be hashed out is national security. And so the underpinnings economically, of course, the UK would like to benefit from a nationalist front economically, but the biggest underpinnings are going to be those freedom of migration, and so they must prove that they're willing and able to hire from outside of London and from outside of UK to show that, we still are going to be a favorable trading partner to Europe. So also UK's top political leaders are changing hands. Prime Minister David Cameron just sort of fell off, and by September 9th we should have a new naming of a Prime Minister for the UK. Another interesting point is the so-called affect heuristic, which is quoted from Mark Carney, and so a lot of market perception is going to stick towards post and pre-Brexit, as opposed to really being able to stay on track with what's really going on. So like there's a difference in between speaking about what's going on and what is actual. So there's sort of like a history making, and that affect heuristic is dangerous for people that are active and engaged in financial markets. So going from the UK vantage point, their top trading partners, of course, is Europe, is number one, and then US, number two, where they have a positive trade balance with us, the US. And then Europe's top trading partners is the UK and the US. So no surprise there. But then the US, our top trading partners are Canada and Mexico. And so going down the line, UK falls into like a obscure number 7 as our trading partner, making them less, we're less reliant on the UK than they are on us. So they depend on the US, but we don't necessarily depend on them. So that's a huge point in understanding trade and understanding what essentially is a Euro camp when you're trading the Euro USD or the British Pound USD. So going on to the next slide, we have basically the retail trading, and looking at the myfxbook.com order book, there's a ratio of short to long positions based on retail traders. And so it's just taking a look at two major developments. First is the Brexit poll, and then for June 28th, and then June 30th is the EU downgrade and from the Standard & Poor's. So basically taking a look at retail traders, I think they're showing a good rationale for like the euro against the British pound. So those traders basically went from going 2 to 1 short position to 1.79. So they basically pared back their short position based on the Brexit poll. It's just kind of worth noting that a lot of the times the prices will get stuck and just will continue on a path dependency, and so despite there being any other news. So June 30th, the EU gets downgraded, and so we go from a 1.83 ratio of short to long to 2.6. So people go tremendously shorter on the euro. So those retail traders are showing a good rationale, basically shorting the euro against the British pound after that downgrade. So a lot of the interaction is going to be in this currency here, and the euro USD and the British pound against the US dollar is just obviously, like I said, is kind of a non-factor. So there's not going to be the same kind of changing of hands. So from from UK and City of London, from their vantage point, obviously, they have a great demand for global currency other than the British sterling. And from the US dollar standpoint, we simply don't have the EU and the British pound high enough on our trading list to really say, like, well, we're a part of this interaction, because we're sort of not. We're sort of ousted in between this, what is essentially basically major developments stemming from the UK. So the key dates to look for basically are going to be this month, July 14th, the inflation report, and then September 9th, the naming of a new prime minister in the UK. And then September 16th, there's going to be a paring back of $250 billion facility of long-term repos. So those are some key dates to look for. And basically, I would really follow the euro against the British pound if you're going to trade the euro with economics in mind, because otherwise everything is pretty much a balance of payments and trade on the order books, and there's kind of a confusion being shown in retail traders in the U.S. And so I think going along these lines, I would kind of follow the analysis and really kind of just go into trading from a European perspective.